Somebody standing behind me. Anyway, all right, let's get started. So thank you for joining. My name's Mark LaMonica. I look after the individual investor business for Morningstar in Australia. Today we're going to talk about bear markets and investing in bear markets and different techniques that people use, and yeah, hopefully answer some questions as well. But first, anything that I say today is general advice. I don't know anything about you. I can't offer personal advice. If you're in New Zealand, get a copy of our FAP on our website, morningstar.com.au, and the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you want personal advice. All right, let's get started. So yes, bear market investment strategies. So what is a bear market? We'll start out with that. A bear market occurs when an index falls 20% or more from a recent peak, and that is a drop bear. So if you Google drop bear, that is one of the images that come up. I like this one better. Most of them just had a regular koala with sharp teeth, but I like this drop bear because they got creative with the coat color as well. But that's a bear market. So in Australia, we've been hearing a lot globally about bear markets, but the question is, in Australia, are we in a bear market? A ferocious bear market? Yes, thank you for that comment. All right, here we go. For most Australian investors, maybe it doesn't feel like a bear market because it hasn't been. So let's go through a couple, and I just used ETFs because I thought ETFs would be a good way to illustrate the market movement, market movements we've had. So let's go through a couple of ETFs. So of course, in Australia, when we're looking at the Vanguard Australian Shares ETF, the most popular ETF in Australia, ticker symbol VAS, looking at Aussie shares, yeah, not a bear market. Now, it was a little bit lower, I will say that, but we've never crossed that 20% threshold, and frankly, haven't even come all that close. So if you're just invested in Australian shares, then you are not in a bear market. But people obviously invest globally as well. So let's look at a couple things. The iShares S&P 500 ETF, IVV, and the iShares S&P 500 AUD hedged ETF. So as we've talked about a couple times on this webinar, hedging, when you are investing internationally, you get the impact of both the share movements of what you're investing in, or bond movements, or whatever, the underlying investment that you're in. And of course, you get currency movements, and they are both components of your returns. So if anyone has been overseas this year, particularly to the US, you've probably noticed that the Australian dollar has fallen a lot. So we can see right here the impact of being in a hedged investment and not a hedged investment. So because the Australian dollar, if you are investing overseas, you want the Australian dollar to fall. That adds to your returns. So because we've had this fall in the Aussie dollar, it hasn't seemed that bad, right? So this one, without any hedging, right? We're just letting the currency fluctuate. In this case, you're only down, close to 14%. Whereas unhedged, or the hedged version, where you're removing that this year, that benefit from the currency falling, you're down close to 25%. So pretty big difference there. But once again, if you're an Aussie investor and you're investing overseas and you're not using one of these hedged products, or you're not hedging those investments, the currency risk on those investments are in any way, yeah, not too shabby. Same thing if we look at developed markets. So Vanguard's MSCI International ETF, so that's looking at 22 different developed markets around the world. Although I will say about 70% of that is allocated to the US. They once again have a hedged version and an unhedged version, same thing. So you see, we've seen falls of 16%. And then if we go look at the hedged version, removing that currency risk, now we're close to 23%. And the reason that there are differences, of course, is because there's different currencies involved, right? You're hedging a lot more currencies because there's allocations to different countries. And then finally, I didn't do the whole hedging thing for this. I'm not sure actually they have hedging thing. If you look at emerging markets, yeah, down 18.62%. So once again, this is the biggest fall in emerging markets because, right, we're only looking at these unhedged versions to compare. But either way, if you are investing in Australia or overseas, you haven't experienced a bear market. So just, I thought, an interesting perspective. Yeah, so Rodney says, who we should get to just come in here and do these. and who I got to meet at our conference and at the Equity Maze conference, he says, yes, but our unhedged investments can get unhappy if the AUD keeps appreciating against the US dollar. Yeah. So what we've seen in the last couple of days, right? So if we look at or last week or something, if we look at what's happened, everyone kind of decided now, the market just seems to be Jekyll and Hyde going back and forth on like what central banks will do. And the market kind of decided at the end of last week that, all right, we're sort of in a place where the Fed, at least in the US, is going to start slowing interest rate rises. It was a comment that was made by someone important, president of the Federal Reserve Bank in San Francisco, I believe. But still, we've had this sort of whiplash back and forth. And so, as an interest rates impact currencies, because if one country, in a very simplistic example, if one country has a very high interest rate and one country has a very low interest rate, well, a lot of investment's going to flow into that country at the high interest rate. And so that's going to impact currency movements. But anyway, as the markets have rebounded, we've seen the Aussie dollar start to rebound as well, which is interesting. And the one thing I will say about the Aussie dollar, and this was a point that was made at our conference by my colleague Tim Murphy, which I think is a good one, is the Aussie dollar, when there are times of economic stress, in general, the US dollar does pretty well. And so what that does as an Australian investor that is investing, not using a hedge, that tends to counteract some of those falls. Of course, that's what's happened historically. Anything can happen in the future. So Lisa says, also met at the conference, looking at hedged versus unhedged, would my unhedged US investments survive the US bear market once I can convert them back to AUD, or would there still be a loss? Well, it depends what you mean. It depends what you mean by survive. So obviously, like, it's not great if you lose 14% in a year. But yeah, it all depends upon the timing, Lisa, when you did that. So obviously all these currency movements, the only 2 days that currency matters from an investing standpoint is the day you make the investment. And then of course, the day you sell it and bring that money back to Australia. So yeah, it all depends upon where you are, when you actually make that, decision. All right. So we're just going to talk a little bit about where we are in the market before we get into going through different investment strategies. And some of this stuff will also be in the podcast we release on Sunday. But anyway, when does a bear market end? Well, nobody obviously knows, but the two sayings that get thrown around is, when there's blood running in the street. So that apparently was said by this guy, Baron Rothschild, a long time ago. And then, of course, when investors capitulate. So this is what, if you Google capitulate, there's this weird guy surrendering with his white flag. Anyway, the problem, of course, with those descriptions is that you have no idea when that actually happens. It only makes sense, of course, in when you're looking back, when everything seems obvious, right? So a couple things, thinking about those two notions. Oh, that should not say dollar cost averaging, but that's a clue to what the next slide is going to be. So a couple of facts that I thought were interesting as we kind of explore this. Has the market hit a bottom? Is it close to hitting bottom? Especially if we look at it around those two notions that investors need to capitulate, give up, and that is sort of the idea that a market has hit bottom. So number one, sort of how investors are feeling about things. So every week, there's the American Association of Individual Investors puts out basically this market sentiment study. And so in late September, and what it basically asks, it asks a bunch of investors over the next 6 months, do you think the market's going to go up or do you think it's going to go down? And of course, you can also be neutral. You can also just say, I don't know, which is frankly the right answer. But in late September, 60% of investors expected the market to fall further in the next 6 months versus 17.7% who thought it would go up. So that is, and obviously the difference, those don't add up to 100. The rest of the people are neutral. And so that's the lowest reading since March of 2009, when 70% of investors were bearish. Now, the interesting thing about that reading that began at the beginning of March, The reading occurred a week before the market hit bottom in the GFC. Now, nobody knew that. And what I always talk about, especially related around that GFC example, is that the economy was in terrible shape still when the market started or ended its fall and sort of started going back up. And so like if you sit there in March, like unemployment in the US didn't peak until 10% in December. And obviously nobody knew that was a peak at the time. And the market and the economy was still had a couple quarters left of recession. So it is very important to remember that, of course, it can feel bad. And like right now, I would say things feel pretty bad, right? So everything from kind of the budget and some of the stuff that was said around the budget this week to the inflation reading in Australia yesterday, to companies stopping hiring, to all these predictions that the economy is going to slow, it feels bad. But just remember that whenever the market starts climbing again, it will feel bad because the market's forward looking, whereas a newspaper is looking at what's happening right now, right? So just something to remember. Are investors giving up? So this idea about capitulating, this strange guy surrendering in front of that white flag. So are investors giving up? Well, some certainly are. And this happens all the time, right? If we think about sort of a market cycle, is that, you know, when we start to accelerate into a market top, that acceleration is driven by a couple different things, but one of the things it's driven by is a bunch of new investors, right? So it's all the people that are sitting around for years hearing about like how well the market's doing, and all their friends are talking about, you know, how rich they're getting and all this other stuff. And then you sort of get people piling on at the end. Well, the same thing happens in a bear market. You have people give up, right? So, oh, maybe investing's not for me. Like, you know, nothing's going up. What am I going to do? So one way that you can tell who's giving up and not giving up is trading volume. So this, of course, is all from the US, but Charles Schwab, 52% since Q1 2021, Morgan Stanley, a drop, Robinhood, a drop. So people are trading less. Could certainly be signs that people are giving up. A more realistic earnings outlook. So part of this, of course, is, you know, we always talk about what is priced into the market. And so if we go back to last year, what was priced into the market was years of low interest rates and the fact that these little, like, you know, beginnings of inflation were transitory and would just go away, right? They were just sort of this COVID like bottleneck as we started opening up the economy again. And of course, those expectations have gotten crushed now. So we do have to look at what expectations are for the future, and earnings estimates are certainly coming down. So we've seen the US is reporting third quarter as we speak. So they've come down, those estimates. Fourth quarter estimates are down. So you're starting to get perhaps more realistic scenarios priced into shares. Certainly, you know, there's widespread anticipation of a slowing economy. So you're starting to get that. And a lot of it's coming from this profit margin as well. So we've talked about this a little bit, how hard it is for companies to maintain profit margins. So basically the difference between the goods that they sell, goods and services they sell with revenue, and then at the bottom line, right? So that's the margin. How much do they keep of what they sell? We've talked about how difficult this is in an inflationary environment because consumer habits are changing, and because you know, companies have higher input costs, whether that's they're paying their workers more, or you know, they're paying more for all sorts of raw materials and ingredients that are going into their products. They're all paying more, and there's these fights, right, between companies to maintain the profit share, like who's going to eat that cost. And so profit margins we can see are starting to come down, right? So a year ago, 12.9%, now down to 12. So we're starting to see that happen as well. And then the last thing, obviously, when we're looking at the market is valuation levels. Now, valuation levels are very tricky because if you look at something like the price to earnings ratio, everyone just talks about the P, right? The price. And so, of course, as markets fall, that price gets less. But the problem is markets fall a lot in poor economic times. And so that E falls as well, those earnings. And so sometimes you can get these unrealistic signals about where the market is, right? Because, it still looks expensive, but a lot of that is because while the price is falling, the E is falling even more. And we saw this during the GFC as well. So if we go back to March of 2009, the price to earnings ratio on the S&P 500 was over 100. It was like at 110. And the reason for that is because all of the profits in the financial services industry in the US and globally, went through the floor, and they made a big part of the index. And so, the earnings fell so much, and they weren't really reflecting, even though the economy was doing really poorly, they weren't really reflecting the economy, because in that case it was a bunch of write-offs as they took loan losses in the big banks. So what we want to do from a valuation level is we want to take a step back and look at the CAPE ratio, which is what I like looking at. And what that does is it's smoothing out the cyclicality of the economy. And it's doing that by going back 10 years and looking at the average earnings. So what it's trying to do is it's trying to give you a more realistic kind of mid-cycle. So not when the economy is doing really well, not when it's doing really poorly, like that mid-cycle earnings is what it's looking to do. So what is the CAPE ratio? So for people who have attended these things or listened to the podcast or anything else for a while, we're always talking about at the end of last year how expensive the market was, and it was really expensive. So the CAPE ratio, this is the US, 38.58, and that was the highest level it had ever been, except for the run-up. And this is by Robert Shiller's data, who's a professor, except for the run-up, and he has 140 years worth of data, literally going back to the 1800s. So besides that run up before the dot-com bubble burst, so the late 90s, that 38.58 was the highest it's ever been. Now, what we've done is we've fallen back to 27. And what that fall means is basically we're at average. So we're at the average since 1990. You don't want to go back too far comparing the market to what it was trading for in 1940, right? But if you go look at 1990, and these are monthly readings, the average is just below 27. So at least we can say valuation levels are average now. Now, I think if we go back and kind of look at markets in general, they generally go below average, especially a measure like this that's smoothing out that earnings. But anyway, we're average, which is good. That's how people describe me. As average. Oh no. Phil is at the trauma ward of the Alfred Hospital listening to you. Well, I'm sorry, Phil. I hope that you and your family, or whatever reason you were there, are okay. But thank you for that. And thank you for Rodney and Lisa saying nice stuff to Phil. So Rodney says, some people quote a rough rule of thumb to invest in hedged international investments when AUD is historically weak, around 60 cents to USD, and invest in unhedged when it's strong. If you go and you look at, and just because obviously I'm American and I still have some money in the States and go there, I look at the exchange rate a lot just from my own interest as well. You do see it's generally in sort of a range around there. Like obviously the Aussie dollar got up to parity at this point a while ago, but it does kind of bounce around sort of that range, right? So I've heard a lot of people, and I don't know what's going to happen with currencies or anything else. I have heard a lot of people saying stuff similar to what Rodney's saying, that, now is a time where, okay, the Aussie dollar is pretty weak. Is it really going to start falling lower? Is it going to break through 60? And a lot of people are saying, no, they don't think it will. And that now is the opportunity for those global investments to look at currency and look at the risk from an appreciating Aussie dollar. So thank you for that, Rodney. All right, so we're going to talk about a couple strategies to invest in bear markets. Now, I kind of hate this whole dollar cost averaging thing, but the notion of dollar cost averaging is, of course, that you are dripping money into the market at regular intervals. And of course, as the market fluctuates, you're buying basically more or less shares. So if you're buying the same company or the same ETF, as those fluctuations occur, as the market drops, you will buy more shares of that ETF. And the notion, I think people are very comfortable with this notion that it smooths out, sort of smooths out your investment, right? Instead of, and it's always contrasted with lump sum investing. So I think people get very nervous about the fact that, okay, if I invest this sum of money today, what if the market falls 20%? Well, obviously, you'd be protected by that if you were dollar cost averaging, because you could then buy more when it has fallen. The issue with dollar cost averaging, there's kind of two issues. Number one, the first issue is, I think that this is talked about a lot, but it's kind of an unrealistic scenario for most people. Yes, there are sometimes times in your life where you do get this windfall that you can go out there and invest, but most people are investing with paychecks. And so, they don't have a choice. And they talk about that they're dollar cost averaging. And like, I guess technically you are, but it's not like you have the money, right? So you're dollar cost averaging because you might be investing whatever amount every time you get paid, and then you don't have any more money to invest. And then you wait till your next paycheck. And people keep calling that dollar cost averaging, and it's not, right? It's just sort of saving and investing. But anyway, if you actually have this lump sum of money, so if you got this windfall, if you sold a house or I don't know what, I guess an inheritance, something like that, and you have this windfall, in most cases, dollar cost averaging is the wrong thing to do because, and we'll talk about some studies we did at Morningstar, because the market most of the time, and we have to remember that right now, given what's happened this year, most of the time the market goes up. So even though you are protecting yourself in your head from you putting this big investment in and then having the market immediately fall, most of the time it's more likely that the market's going to go up and that you are going to dollar cost average into a rising market. And so we did this study right here that looked at and went back historically, so 1926 through August of 2019, and looked at dollar cost averaging, so DCA, that's right there, versus lump sum investing, LSI. And basically looked at, okay, what are the cases when doing dollar cost averaging was actually beneficial, was actually positive for you? And so what we can see with the length of period, and we're talking months here, right? So up to 10 years, most of the time, even when we're looking 2 months out in the future, most of the time, just putting the lump sum in was the better move. And the longer we go out, right, up to 120 months or 10 years, we're below 10% of the time where it is a better decision to dollar cost average. So just remember that, and particularly remember it now, that even though things feel really risky, the market is safer to invest in now than it was in January, right? Why? Because it's fallen. So just something to think about. But dollar cost averaging does work in a bear market, but just realize that it's a market timing strategy, and you better be right about where the market is going to go. And so I think, obviously a lot of people, and we saw that with the surveys of who's bearish and who thinks, most people think the market's going to continue falling. And I would have to say I'm in that camp as well, but that doesn't mean it's going to happen, right? We don't know. So just remember, dollar cost averaging is market timing, and it does not work and is negative if the market goes up, and the market goes up most of the time, right? So it's not a coin flip every month whether the market goes up, because the odds are it's going to go up on the average month. So that's one technique. Another thing that people do, and I will say I like this strategy, then we can look at the results. Another thing people do is this notion of investing in quality, and we'll talk about what that means in a second. But quality is referring to companies, quality companies, and there's all sorts of different measures that people look at in terms of quality. So at Morningstar, we would talk about moat. So companies with sustainable competitive advantages are quality companies. A lot of people look at leverage. So how much debt does the company have? The lower the amount of debt, the higher quality the company is. People look at, they look at earnings, and how volatile earnings are. So the notion that quality company will not have a lot of volatility in earnings. And so, especially when we start looking at sectors, what that means is generally safer sectors that are less cyclical. So cyclicality, of course, refers to the economic cycles we go through and how that impacts a company's earnings. So an example that I talk about a lot, but healthcare is a generally non-cyclical sector because, of course, people are going to keep paying for healthcare no matter what's going on. So that earnings variability is thought of as quality. And then we can sometimes look at metrics relating to how efficient management is at investing capital. So we like return on invested capital at Morningstar. Other people look at return on equity, but basically they're measures of how effective management is at using the assets of a company to generate profits. So anyway, there's lots of different definitions of quality, but the thought is that quality is a defensive strategy because, of course, when the market is really worried about risk, they're going to avoid all those companies that they think are really risky. So quality can also be denoted as just large cap companies as well. Thought that these bigger companies are better quality than lower companies. So quality to me is a long-term strategy, but people think about, okay, it's time to get defensive. So I want to start moving into quality companies. I don't know why you'd ever move out of them, but once again, that is my point of view. Now, there are a bunch of ETFs that have come out that are tracking or they are investing in quality companies. Now, a couple caveats. They all have different definitions of what quality is. For example, these last two ones, Moat and the Australia version, DVGY, we actually license. So little disclaimer, Morningstar licenses our index. We have an index business to VanEck. So these are not Morningstar products, but VanEck pays us to use our Moat index. Whereas the same thing like the S&P 500, right? If you have an iShares S&P 500, they are paying Standard & Poor's for using that index. So Morningstar is the same in this case. So I just throw that out there. But so these two are looking at Moat. So they're looking at our analyst assessment. I don't know all the specifics about each one. I know Qual, this other VanEck product. So it's looking at three measures. It's ranking companies based on debt. So low debt, better. Return on equity is what they're using. And then they're looking at earnings variability over time. So that's a quantitative screen. But anyway, all of these different ETFs, and there's more, are trying to invest in quality companies. Now, this downside protection that we talked about, not really playing out in most cases. Now, a couple things. We're looking at year-to-date returns. You should not use year-to-date returns to pick an investment, right? We want to look longer term. And I will say at least Qual and Moat have beaten their respective benchmarks by about 2% in the last 8 to 10 years, which is good, right? But this promised downside protection is not materialized. So what you've seen is, and I picked the respective indexes that all of these follow. So these top three are following a MSCI developed market index. So looking at developed market countries, this guy's following an S&P 500, and this is following Aussie. So those should look familiar from the other side. But yeah, you can see that in almost all the cases, except for this QMix one, they've actually performed worse than the index. Oh, Moat's done better year to date as well. But you have seen some pretty big drops. And I just spent some time looking at Qual, which is why I keep talking about it. One of the reasons is that if you think about, especially this one, especially Qual, because they're looking at the cyclicality or the variability in earnings as one of the measures, they tend to avoid, and they do avoid, a lot of sectors. They avoid financials, they avoid resources, so basic materials and energy, because they're more volatile because they rely on very volatile commodity prices, and financial services is really cyclical. So what you tend to get is you get a lot of technology investments in qual. And tech has obviously not done this well. So that's really why that one has underperformed. But yeah, quality hasn't worked too well. We have some questions. So Peter's saying, what was the CAPE from 1990 to 2008? Well, so these are actually, so Robert Shiller's numbers, he takes monthly readings and all the data is available. So literally, he's a professor at Yale in the US. So if you just Google CAPE Shiller like data, you'll go to this very like old website, but you can download, you'll see there's some links on there. There's a couple of paragraphs, there's some links, and you can download his download all the figures into Excel. So it varied between 1990 and 2008. So obviously every month it is changing. So he's literally updating this every single month. So it's varied, but the average between 1990 and 2000 and now, the average is at 26.4 or whatever it is. And you can go in there and obviously just see the average and see where it's been at different levels. It's kind of interesting, but maybe maybe I'm just boring. So Peter says, are we able to get the Morningstar mode index? Assume the mode index is a list of benchmarks to compare, think about when selecting companies. Yeah, so let me describe what the mode index is. So what they're looking at is they're looking at two different things. I'll talk about this US mode because I just know it better, but the Australian is going to use the same methodology. So US, what it's doing is it's looking at the entire market, and it is looking at shares that our analysts rank as wide moat. So they've received a wide moat ranking. And then what they do is they pick the cheapest ones. And it's a very, very concentrated index. So this Van Eck ETF right now has 48 holdings. And so basically, and even though our analyst rating are qualitative, right, a human sitting there saying, I think this is the fair value, I think this is the moat, the index has rules. So it's basically taking those analyst ratings, and every 6 months, it looks at, okay, what are the cheapest wide moat stocks according to our analysts? And it goes into that, index. So yeah, you can certainly get the constituents in it. Email me and I can send it to you, or it's on the Van Eck website. So go look up Van Eck moat and go look up holdings, and you'll see the holdings. But if you can't find that, let me know and email me. All right. And it has and the Aussie one has not been around very long. I think the Aussie one was launched about a year ago. So it really doesn't have that much of a track record, but the US track record is really good. So as I said, yeah, it's beating the S&P 500 by somewhere around 2-3% since 2 or 3% a year since inception. I will say, our analysts don't rate these because they figure it's a conflict of interest, but I can talk about it. All right, what's another approach we can take? We can move into cash and invest when things are safe again. So this is obviously market timing. And this is, a lot of people say this, and frankly, intuitively, it makes a lot of sense, right? So it's one of those situations where you sit there and you say, okay, everyone thinks the market's going to keep falling, right? So that's where we are now, right? 60% of people think the market's going to fall over the next 6 months. Only 17.7% think it's going to go up. So most people think it's either going to fall or stay the same. You pick up the newspaper, you read all this horrible stuff, right? The economies are slowing down, the Russians are going to use nuclear weapons, blah, blah, blah. You keep reading all this horrible stuff and you think, all right, things seem really unsafe right now. So I'm just going to take my money and then I'll just invest again when it's safe. Who cares if I move everything to cash, because everybody knows that the market's going to keep falling. Well, obviously, we all think the market's going to keep falling, but we have no idea what it's going to do. Same thing back in March of 2009, where everyone said, 70% of people said the market was going to keep falling, but it didn't. It started going up. And these are still horrible headlines and horrible news. And if you're sitting in the US and you have 10% unemployment, doesn't feel very good, right? But the market's forward looking. So it's looking past what's going to happen. So when they're sitting there thinking about right now, when the market is like looking at interest rate expectations, it's not looking at what the RBA is doing next month. We know what they're going to do next month. They're going to raise rates, not looking at what the Fed's doing. It's trying to think, okay, when will they stop? And trying to predict when that stop is. So the problem with market timing is that if you miss a couple good months, you are in trouble. So this chart right here shows, and we're looking at $10,000 invested on the 1st of January, 2001. And we're looking at Australia. So basically Morningstar Australia, GRAUD, that is it's a Morningstar index, but it's the Australian market. It's basically whatever you want to call it. ASX 200, 300, doesn't really matter because of how overweight or how much is invested in the top holdings. So yeah, what happens if you miss a couple of months? You can see that you have 33% less money if you miss the 5 best months in this 20+ year time period. So that's the issue. And when the market turns, it generally turns, right? And it turns really quickly. And the returns in the 6 months, and I don't remember exactly what they are, but if you go back and look at the returns in the 6 months from that March of 2009 low to, or I guess it's a couple more than 6 months, 9 months, until we get to when even unemployment peaked, and nobody knew that at the time, right? But even if we look at those returns, like the market did very, very well. So the market tends to roar out of these things. And if you miss those really positive months, you're obviously in trouble. And a very interesting thing about the share market, we always hear, and it's true, of course, that the share market earns so much more than cash and why you need to invest in it. And that is 100% true. But it's really interesting that when we went back and did this survey, this is Morningstar research, between 1926 and 2018, the only reason U.S. stocks outperformed cash was because of 51 months. And that's out of 1,104 months. So that's like 4% of the months, right? Which is crazy that if you took away 4% of the months that you experience in this very long time period, you would have gotten the same return as cash. So this is why it's very, very difficult to time the market. And these are the perils, as this chart says, the perils of timing the market. So something important to think about. Okay, so we've got a question. Sorry, I will go back a slide. So we have a question about the difference between the year-to-date returns and the year-to-date index returns. Okay, so what all of these ETFs are doing, I should have explained that more, is they are taking basically a universe of shares, and they are picking out the ones that they think are quality, right? So if we look at this US MOAT index, they have picked 48 shares that they say represent the highest quality companies in that whole index. But the whole index is the S&P 500. Right, so the 500 largest shares in Australia, in the US. We look at this Australian MOAT ETF. So they're looking at the ASX 200, right? They're looking at the 200 biggest companies in Australia, and they are selecting the quality ones. So what we're comparing here is we're comparing, is what they selected, did those quality companies, did they outperform or underperform that index in a time when markets fell? Now, once again, year-to-date return is a very short period of time. I wouldn't recommend anyone use that, right? We all know what date it is. So we're basically looking at returns through the end of September at this point. So I wouldn't recommend anyone does this, but I was just sort of testing that hypothesis that quality outperforms during market downturns, right? So like, a lot of people, like if they could have foresaw what was happening, somebody said, okay, on January 1st, somebody told you, you're going to be sitting there at the end of October and markets had fallen, whatever, 25%. A lot of people would say, okay, well, I'm going to rotate my portfolio into quality so that my portfolio won't fall as much. So all I'm saying here is that for the most part, this thesis hasn't really held up, that quality outperforms during downturns and underperforms when the market's accelerating. So that's all I meant by that. Rodney goes, yes, isn't this kind of what you've been doing? Yeah, it is what I've been doing. The market, and Rodney said, not judging. He's been doing something similar. Yeah, it is what I've been doing. So for anyone who's sort of listened to podcasts, don't do what I do. That's the important thing. But yeah, listen, my sort of theory is I haven't been building up cash now. I've been building up cash over the last couple years, and now I've got some cash to invest, which is a good thing because the market has fallen. And it is like 100% market timing is what I'm doing. The reason I did it, I guess the way that I sort of justified it, is I didn't quote unquote need the money invested, because I was trying to track against some very specific goals that I have in terms of returns. And because my portfolio is doing so well, like everyone else's, the last 10 years, that return that I needed got lower and lower and lower, which meant I could take on less risk. So essentially it was allocating more to cash. And I knew I was going to put the money into the market at some point. And we'll see, like ultimately, we'll see sort of when it all gets invested and where it was. So yes, that is what I'm doing. And you can judge me, Rodney. I deserve to be judged. I believe that's everything. Yeah, there we go. Look at that. Emily's happy because we finished. I wish people could see how Emily looks at me. It is utter disgust. Yeah, so Rodney's saying it is a good point. I never sold anything. So, I was not raising cash into the market it's just sort of leaving invested what was invested. So this cash that's built up has built up from dividends and from new contributions that I've saved. So this is why Rodney should do this. Should do this instead of me. So Peter says, oops, perils of market timing. Should share market valuation be linked to debt growth and cost of interest? If debt decreases due to increased interest cost, then the future may be different from the past. Yeah, I mean, I think one of the things that's really important is, if we go and we look at, for instance, valuation levels, right? So, I can make that statement that the valuation levels in January were at the highest they've ever been. Now, what people would say, except for that .com, what people would say is those valuation levels are justified by the level of interest rates. And maybe they are, maybe they aren't, right? So as interest rates change, of course, valuation levels are going to change. And for all sorts of reasons, one reason being that people need return. And, at the end of the day, people certainly do. I think all of us need that in order to achieve our goals. Pension funds need returns. All sorts of entities need returns. And so as interest rates go lower and lower and lower, a lot of those, particularly pension funds and institutional investors and insurance companies and all the people that are investing these big pools of money, the Future Fund in Australia, super funds in Australia, what have they done? Well, if they can't get any return from bonds, a lot of them just plowed more money into the share market. So that's a very real example of how interest rates impact valuation levels. The other thing that low interest rates do, of course, is it's good for people who borrow money. And who borrows money? Companies and individuals, right? So, same thing with houses, right? Interest rates go down, housing prices generally go up because most people just go to the bank and say, how much can I borrow? And then borrow it. And that's how they know what house to buy. So yes, it can't be looked at in isolation. I think the question is where do we think normalized interest rates will be? And I think that's what's happening a lot with the market, that people are sitting there now and they're saying, okay, what was happening? The level of interest rates, the drop in interest rates basically that happened during COVID and people hoped it would last for years longer, and they thought it would last for years longer because central bankers told them it would last for years longer. But now that we have inflation, I think people are starting to realize whatever the normalized level of interest rates is, it's not whatever the RBA got down to, 0.15 or whatever it was. That's not the level. So maybe the level's 3%, and maybe 3% seems unimaginable to people who've lived through the last couple of years, but historically, that's a lot closer to what historically average interest rates were, right? So yes, I think that's a very good point. All right, so we've got Craig says the index for DFDY is only updated semi-annually. Do the ETF adjust stock weighting according to their own insights, say monthly, or only track the index? Okay, really good question. So one of the issues that I have with sort of these quality ETFs, and a lot of ETFs, so they do update the holdings. So go in and look at every single one, but they will follow the index. So basically, if you look at that Morningstar moat, I said that happens once every 6 months. So once every 6 months, they re-rank everything, because right, that price to fair value that they're using along with the moat, but that price to fair value to say these are the cheap shares, that of course changes every day as the market changes. And so every 6 months they re-rank them. When they re-rank them, then the ETF has to go out there and do all those transactions. So, and the Morningstar index, for example, is equal weighted. Right? So every 6 months, they are rebalancing to bring everything back to equal, but they're also getting rid of securities that fell out of that moat to price fair value index and buying all the ones that weren't in there. So one of the problems that you get with these is you get a lot of turnover. And so if you look at, and I don't know that, I know this stuff because I was looking at it this morning. I don't go around, I can barely remember anything. That Morningstar index has a 49%, that moat has a 49% turnover rate, and that qual ETF has a 25% turnover rate, something like that. So what that means is 49% means that in the last year, half the securities are new, right? So what it's doing is it's going in there, if there's 48 securities, that means 24 of them are new. And same thing with that qual, it's about 25%. A quarter, every year, a quarter of those securities get turned over. Now, the problem with that is you're an investor, is depending obviously upon market conditions, but if markets are going up, those generally generate capital gains, right? So think about it, the stock market's going up and they're selling something that's appreciated since they bought it. And the problem with that is those capital gains get distributed to you, right? So it'll come out as a dividend. But remember, it's not a dividend with ETFs, it's a distribution that is capital gains and it has dividend income that the securities own. And so those capital gains, like if you're really lazy like me and just did your taxes 2 days ago, like those capital gains that are distributed to you, of course, you have to pay taxes on those, which is not great. So that is, that's an issue, and something you really need to think about with ETFs. Whereas in your own portfolio, if you bought individual shares, you could choose the timing of realizing those capital gains, right? Because you can sell something when you want to sell something. So it's an index, it's a problem with things like this, right? The S&P 500, the ASX 200, they change every once in a while, right? Because they're looking at the biggest companies. In Australia, if we look at the ASX 200, the 201st company becomes bigger than the 200th, it will go into the index. The other company will go out of the index. So you do get changes, and that will involve obviously transactions, but they're very minimal compared to these ETFs, like an equal weighted ETF that's going to rebalance to get everything back to equal, like the examples I just used, these, sort of factor-based ETFs like quality, certainly, and Rodney just said it in the chat, the FANG ETF, it has 10 securities, it rebalances quarterly. You're getting these huge capital gains distributions to you if it keeps appreciating. If you go back, and FANG is an interesting one, FANG owns 10 shares. It's really, really concentrated. And if you go back and you look at FANG and you look at what it's done, it paid this huge distribution last June, I believe, paid this huge distribution. I saw these people on these message boards being like, this is awesome. Like, it's so much dividend income. I was like, well, no, I won't say the word I used. No, go look at the companies in this, because there's only 10. It's really easy to do. 9 of them don't pay dividends. 1 paid a dividend, and a very, very minimal dividend. So this is not dividend income. Everyone thinks that these payments that come out of an ETF are dividend. It's not. They're distributing capital gains to you, which maybe you can just sit there and say, fine, it went up, I'm going to pay. But at least like investing in individual shares, you get to choose when those are distributed. And the last thing I'll say about this, because I'm going on a rant and Emily's going to give me a dirty look again. The last thing I'll say is that's why a lot of people like LICs. So the advantage of a LIC is the manager of the LIC gets to choose when they distribute incoming capital gains to you. So what they'll do is they'll generally smooth it out. And they want to smooth it out because they know a lot of retirees are looking for income. And even though it's not all income, they're sort of smoothing it out. And a lot of retirees are the ones interested in LICs. So anyway, all right. Well, that was that. Sorry, Emily. Now we only have 9 minutes until the next meeting. But thank you guys for joining. Appreciate it. If anyone has any questions, you can email me at mark.lamonica1@morningstar.com. And Phil, I hope you're doing okay. And you are in the hospital for a short time, whether it's for you or somebody else. So anyway, thank you.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.